what inspired you to shift from being a founder to become an investor, JJ?
That's really a hard question. As two founders, started several companies, you start thinking, what's my next thing? And I wasn't sure what an angel investor is, but I started looking into it, and then I found the Techos Angels, and I joined just to learn what that is. So I learned that founders are important to the ecosystem, but of course, as important angels are. I was really new at the time, didn't know much about investing, but now I've been in it for about 16 years or so. So it's a different world now. But I am one of those that sat on both sides of the equation.
Right, thank you. JJ, you are part of multiple angel groups here in Southern California. You are an ecosystem player. We meet at so many events, which happens here in Southern California and worldwide. Uh, you are part of Tech Post Venture Network, and then you also started your own firm called Pismo Venture. What was the idea behind Pismo Venture and what it is doing in the startup ecosystem?
Um, the main reason of starting Pismo Ventures was to really um, first, find good companies that we can invest in. That's the first thing. But really, at the heart of it too is really to really help entrepreneurs understand the ecosystem and navigate the ecosystem. As you and I know, we see each other all the time. We run in the same circles. We see the same founders, the same investors, and 90% plus 95% of the companies that we see or we invest in end up failing. And this failure, in my opinion, could be preventable. We should be able to help these founders succeed.
Right.
Um, and one of the things Pismo Ventures is really to help these founders succeed in what they do. And I always use the word help them decrease the risk of failure and increase the probability of success.
Right.
So if we're able to do that, not only as Pismo Ventures, not only as me as an individual, but as as part of the ecosystem with you and others, we can really truly help these founders uh, potentially decrease the risk of failure and increase the risk of success.
You have must have seen over what 2-3 thousand pitch uh, and pitching events and pitch judging. What what how a founder can stand out in a pitch competition?
It's, I guess the question is easy, and the answer to the question is easy and hard at the same time. Um, um, you have I think one of the most important things is you have to be very clear about what you do. You have to understand, you have to be able to tell your story in a very crisp and concise manner, because a lot of the time you don't have much time. You usually have, you know, depending on many different aspects and the different events, anywhere from 30 seconds to maybe 10 minutes, right? But most of the time, you need, as a founder, you need to be able to um, immediately um, you know be able to explain what you're doing very quickly to the investors that you're in. So to stand out, you need to be crisp, you need to be direct, you need to know exactly what you're doing, what the value proposition that your business provides, how is it better for the customer, and then your business model, and then what's in it for that investor.
Mhm.
It's really hard. Everybody says it's really hard to do in a short period of time, but you and I have seen this over and over again. People can sometimes can do it in a minute or two, and they're so quick, so and you understand them, and you want more. So the most important thing after that little interaction that you have with the founder is for them to convince you that you should talk to them again. So if
Yes.
they can convince us that we need to learn more, I think that's key.
Yeah, so true. In some of the pitching events that I'm part of, and I've seen that many founders can't even complete their pitch in the allocated time, be it the 3 minute, be it 5 minute, 15 minute, 10 minute, whatever, And many a times the founder get tangled between the technology that they are building and they forget the business part of it. That what is in there for the investor who is going to invest in the company without any collateral, why they should be taking that risk with the founder. Sometimes they are not at all a good storyteller. They could be good founders, but they cannot communicate to the investor. And then Q&A, another thing. What is your take on that? Many a times I've seen that there is a question and 3 minutes for Q&A, 5 minutes for Q&A. The founder will take so much time in answering the question that the other investor can't even ask them another set of questions. How do you feel about
Yeah, very true. I think um, most of them want to tell you their life story when you ask a question. They want to tell you everything about it. And knowing that there is a very short period of time available, they still do it. As I always advise them to be crisp to the point and answer the question very quickly and very concisely. Um, but most of them just want to tell a lot more. Um, I think one of the things that I always advise, and not many do, if any, is to actually practice that pitch. Practice, and then make sure it's concise, and bring in your 5-year-old cousin and see if that 5-year-old cousin understands it, regardless if it's a life science pitch or a software pitch. The value proposition should be understandable to anybody. It should not be that difficult or complex. The more complex it is, you're going to confuse the investors on the other side, and they're going to start asking even more questions. And if they don't get their questions answered, they're going to be frustrated and not interested. So it ends up being detrimental to the founders not being prepared, and then not being able to answer questions quickly, and therefore losing interest from the investor side.
what is your take on some of the red flags? A founder comes in, they give you their pitch deck, or they go through a deal flow platform, and you have their whole application in front of you. What are some of the red flags that, as a seasoned investor like you, will spot right away in a founder?
You know, been doing this for too long now. So sometimes what's really interesting, Anshuman, is um, I I get I'm able to, if you want, which is really weird, but I'm able to make a decision about if there is any interest or not in the first 30 seconds of listening to a pitch. It becomes quite apparent. One of the first things that is really a huge red flag for me is, arrogance. If someone is really, really arrogant while they're pitching, um, or sometimes the other side of it could be too salesy. So if they're too salesy or too arrogant, I'm turned off. I'm not listening anymore. So it just they could be talking for the next half an hour, and I'm just tuned out already. Arrogance or too salesy, that's one flag. They're really opposite of
Mhm.
each other to some extent. But the other thing is, when I'm already maybe 2 minutes, 3 minutes into a pitch. This is, let's say, a normal pitch, which is 10 to 12 minutes. You're already 2, 3 minutes into it, and you still don't know what they do. And you're like, okay, how am I going to understand the rest of it? I still don't know what they do. I still don't understand the problem. I still don't understand the solution. So that's a huge issue, is not understanding really what they're trying to solve, what they're, again, back to the value proposition, back to what solution they're doing. So those are, I would say, the biggest red flag. That there's too many that I can count, but as you're going through the pitch, it would be not understanding the business side of it, which means financials, which means not understanding their business model, how to charge the customer, all that. So I can go on and on, but these are would be at the top of the list.
JJ, in your experience, the Tan Sam song to the angels, if they come like uh, the total addressable market is $1 billion. How do you feel about it?
They $1 billion is okay. That's where I'm hearing lately so much more. So they try to make it bigger, 40 billion, 50 billion, and they try to make it as big as possible, um, thinking that the TAM is really the most important. But that's not true. What's really important is the SOM. That's more important. What can you actually obtain? Serviceable, obtainable market.
Market,
So
right?
if you cannot obtain whatever it is in the next 3 to 5 years, your business is probably not a viable business for investment. It could be greatly viable for you as an individual, as a lifestyle business. There's nothing wrong with that. But as angel investors or early stage VCs, um, we're looking for someone to have a revenue in 3 to 5 years between, I don't know, 20 to, let's say, 50 million, but above 20 million for it to make some sense,
Mhm.
um, in the 3 to 5 years. And that's what the Psalm should be. All the other stuff is a little bit of a fluff. Yes, it's great to have a 2 billion, 3 billion, $20 billion TAM, but what can you grab out of it? Can your product or service, um, does it have can it have traction? Will somebody pay for it? And will you be able to make sales? Can you scale that business? Because again, it's we can talk about that more, but at the end of the day, it ends up being about the team. You can have the greatest idea on earth, which I heard yesterday. It was a great idea, but the founder was not even close to being able to make that business work. So you can have a great idea, and as long as if you don't have the right team to scale it, um, it's not going to get there.
Great. Yeah. JJ, I would like to also update you. You have been a robust user of our deal flow platform and then the demo day platform of Start Steroid. And the other day, Asif and I were discussing with you about the investment ready type of score. We were calling it readiness score. You guided us that, call it not an investable score, but a ready score, how ready you are in front of the investor, and is your application complete, what are the missing things. And I'm happy to report to you that that product is ready now. We have just launched it. We have some paying customer coming in and testing it out. The report looks great. I'll be sharing it with you to pick up your brain further to develop the product to the next level. What is the investor ready really means to an investor like you? What should the founders do to become an investor ready? So that, because you only get one chance. The typical no's are, you are too early, you are too late, show me some traction, come back after 6 months. Those are basically polite way of saying no.
Yep.
So, what is the investor ready really means to a founder, or what it should really mean to a founder?
Yeah. Yeah. So, um, first of all, thanks for taking my suggestion. The investment, or if something is investable or not, is really so subjective
Yes.
that that it's really hard to tell one investor that this is investable versus not investable, because it's so subjective. They may understand the industry better, they may know this, they may know other things. There are different factors involved. um, the readiness part of it, I think, could be potentially objective, right? Where if they have all the elements in place, then objectively they could be ready. They still may not be investable. That's that, but they may be ready, right? So So to answer your question directly is, it's the things that we talked about to some extent, and that is, um, one, do they have a team? Is it the right team in place?
Mhm.
Do they have experience in the industry? Because I have seen over the years where someone came up with an idea, has no experience in an industry, and they think they can conquer that industry, but there's more to it. So team with industry experience, that's one. Again, understanding the value proposition very well. Why would someone buy this product or service? Is there a good product market fit? So that needs to be there. It needs to be one of the first things they do. Third is the go to market strategy. One of the things that I look at very, very closely is, well, you have this great product, you have this great service. How are you going to get it in the hand of your customer? And it's one of those things that are very difficult to do. It's probably the most difficult things is developing a cure for cancer, but you cannot sell it to anybody. You cannot get it into the right hands of the right customer. So the right go-to-market strategy is hugely important. Um, and then, I mean, we talked about the team, but how you're going to scale it after that, right?
Right.
Uh, the other thing for readiness would be the terms of the deal. Um, Sometimes we hear a bunch of stuff really, really great, and then we get to the terms and they're brand new, have no revenue, and $50 million pre-money valuation. And what do you do with that? You can't do anything with it because uh, at the end of the day, there's what's in it for the investor. And at $50 million pre-money, and they don't have any revenue, for example, that investor is probably not going to be able to make money return on their investment
Right.
because just a simple example, most companies sell, let's say, between 100 and $300 million, and if the investor is looking for 10 times their money on average, right? Maybe 20 times their money, at a $50 million valuation,
Yeah.
let's say they exit, you're never going to get to 10 times.
Hmm.
Even at 100 to 300 million, you're never going to get to 10 times.
Yeah.
Um, and why do we want to get to 10 times? Is because of the high rate of failure. If we
Right.
can get them to not fail, I think we could have higher valuations.
Right, right. Let's talk about the valuation a little more. There are obviously 4 or 5 models for valuation. It depends upon industry sector to sector, verticals to vertical. What is the hype? Like, these days, AI, anything, everything is having AI somehow or the other. What is the valuation criteria that, as an investor of Pismo Venture, individual investor, and a TCA Venture Network member, how do you value a company, and what type of discussion goes on, and how a founder should be preparing themselves? Are those numbers fixed? Are those numbers negotiable? How it goes?
Yeah. So when it comes to valuation, again, there's no. It's somewhat of an art and science, so it's not really exact, right? So, um, for early stage investments, pre-revenue to maybe some traction, some revenue, I would say, somewhere between 5 and 10 million is about right for early stage investors. Now,
Mhm.
later stages is different. There's more traction. They've already proven that that comes later. So, have we seen or have we invested in companies that are maybe 15 million? Yes, but again, the higher it goes, if you add to it the risk of failure and then the expected return, uh, it becomes really hard to get to that point. But so again, I would say 5 to 10, maximum 15. Um, but again, I think lately you start seeing like today, at Pismo, at TCA Venture Group, and many others potentially as well. I think Thai SoCal and others, they're if it goes over 10, it's going to be hard to swallow. Um,
Very, yeah. So true.
um, so yeah.
Yeah. Okay. What's the real role of angels beyond the check?
um, so I think the most important thing that angels can do is really potentially open doors
Mhm.
for startup founders. Um, uh, Also be on their board and guide them in the right direction, because these founders, most of them are first timers. Although yes, we'd like to invest in repeat founders, but most of them are first timers. They don't understand that they need a board. They don't understand that it is really really difficult to start a company from scratch and build it. So having an angel or an investor on their board is really hugely important. Having an investor that understands their industry really well and has connections in the industry to help them open doors is really great.
Mhm.
Um, Also, investors are good sounding boards. They're usually good business people, um, and for founders to just think that, okay, I'll take the money and I'll go and run my business, and I will check back with the investors if I need to. Well, what happens is a lot of times, because founders are at the helm of a company, they're really alone. And I think they should be reaching out to the investors and ask them for assistance, especially if they're stuck, they need to pivot. A pandemic happens, and what do you do? So I think they're good sounding boards, other than being board members and potentially someone who can open doors and guide them.
Right, right. So true. What gets JJ personally excited enough to invest in a founder or a startup?
Uh, um, I really think someone who is on the borderline of being stubborn, but also coachable. Because you can't have a founder that just says yes to everything. They need to be well rounded. They need to understand their business really well, but they need to understand that when to pivot and when to learn and when to be coachable. So it's a really hard combination, in my opinion, to find a founder that's really that could have all these features. Um, but also someone who really understands their customer. Um, if they understand their customer, they understand their real pain, um, and they understand how to get that solution into their hands, is someone that intrigues me quite well, regardless of what industry they're in.
Mhm. Solo founder, I startup with co-founders or multiple co-founders. What would you prefer more?
Definitely, multiple people is better. First of all, because they need to be able to work together. That's for sure. But it has to be multiple founders, or it doesn't. They don't have to be initial founders, but at least there's a team, because
Right,
you need someone who's a founder, CEO, that understands really the problem and the solution really well. You need the marketing person, you need the financial person, and you need the technology person, regardless if it's life science or non-life science. So at least those four people that are integral part, which is again sales, marketing, founder, CEO, technology, and a financial person, someone that understands the business side. Those are really key. Yeah, you could start with one or two, but eventually, before an investment happens, you need that, but also you need a board on top of it, or at least an advisory board, if not a an actual board of directors.
mhm. So true. Common blind spots that you have seen founders fall in the pit. Common blind spot that it is there, but it is so difficult for the founder to see.
Wow, that's a really good question.
I have seen, like, there are two co-founders and they don't have a founders agreement in place.
They don't have what? I'm sorry.
The founder agreement in place, who owns how much. Their cap table is completely screwed up. They have
Yeah,
taken a smaller check, and now $5,000 investment is on their cap table, and they have 50 plus people on their cap table when they have raised $100,000.
yeah, yeah, yeah. So on that one, so yeah, I have a related one. So a lot of time, actually, this happened not long ago. I think it was late last year or earlier this year.
Mhm.
A founder came. She has traction, um, revenue. Um, she's raised already $3 or $4 million, um, or more, and she had left only about 10% of the company.
Hmm.
So now what do? You look at this, you look at the cap table, you look at what she owes. She's the only co-founder. She has a team. I mean, she's the only founder, sole founder. She has a team, and they all have options. But now she's left with 10%. And then you say, so maybe they don't see that, right? They don't see that. So the entire this was part of TCA Venture Group, and
Mhm.
then we all had one answer, and that is she does not have enough at 10% to be able to continue to run this business. There's not enough incentive for her
Right.
to do that. So I think that's definitely a blind spot that she probably didn't think of. Um, so that's definitely one of them.
Yeah.
Uh, the other one is like you said, very large cap table. Um, they don't know that this could be detrimental to their business. They don't understand the consequences of having such a large table in place. The
Mhm.
other one is maybe having a team that has no they don't have any risk, they don't have any equity, they don't have any options, and the problem there is that that team could leave any day because there is nothing for them to look forward to. And so usually that's what some of the founders do. They want to really hold tight to that equity, and holding tight to the equity doesn't give the rest of the team enough incentive to be part of that team and stay on board.
Right. Right. Okay, so now we are in the last segment of our video cast. We are going to talk some rapid fire kind of question and answer, one liner, two liner type of answer. Uh, one or two most important piece of advice that you would like to give to the first time fundraisers.
I would say be very direct, be very crisp, and the first objective you have is to get a second meeting or another meeting with an investor or a set of investors that you're pitching to.
Great. What's one startup myth you wish every founder would stop believing in?
One startup myth. Okay, I would say that if they build it, they can sell it.
Sure, sure. Great. Let's do some, red flag that kills deal, regardless of how good the product is.
Um, I would say not understanding their numbers, not understanding what the investment dollar is going to do for them, what milestones they're going to hit in order for them before they raise the next uh, tranche of their investment. So not understanding business model and the dollar, what the investment is going to help them hit what milestones.
Great. What is your industry forecast, JJ? What the new founders who are coming into the industry should look at? What they should be building? Is this the AI? AI is the hype, or AI is the future? What is your take on it?
Um, well, as you know, as we talked about, it's a big hype with the AI now, right? So I think founders who are trying to have an AI solution, they need to actually first find a real problem that they could solve with AI. It shouldn't be an AI company for the purpose of being an AI company. It should be an AI company that really solves a real problem in the marketplace using AI. And please don't be another LLM or a wrapper on LLM, because everybody's doing that and that doesn't get you anywhere.
So true. So true. Thank you so very much, JJ, for your time today. Thanks for coming on the show and guiding the startup founders who are building something great, something new. It is always a pleasure to meet with you and to talk to you. There are some upcoming events happening in the ecosystem here. We are doing an event with the help of SBDC and Octane at Chapman University. It would be the last, like the last time one, which we did in February. So pitch coaching, I would love to have you as a judge over there. I'll be sending you some invitations related to that. It is in first week of August. I think it is on August 6th. So if you are in town, please mark your calendar, and I'll be reaching out to you later in the day today. Thank you so much for giving me the time and the opportunity to talk to you, JJ.
My pleasure, Anshuman. And just want to also put a plug. Pismo Ventures will have an event either on September 23rd or September 30th. And so we, stay tuned for announcements. So we haven't finalized the days. But
Absolutely.
again, thank you very much. And anyone, feel free to reach out to me on LinkedIn,
Yes.
linkedin.com/JJ Richa.
Yeah, yeah. And all those contact details will be in the description of this podcast when it will be published on YouTube. Thank you so very much, JJ. I'm closing the show now.
Thank you. All the best, Anshuman. Have a great day.